Good evening, everyone.
Good evening.
So let us start with the today's session on discussing on portfolio concept. So in the previous session, we discussed on concept of CAPM, and we discussed the concept of risk analysis and standard deviation and calculation of various aspects of beta with the help of manual as well as functional aspects. Okay. So today's topic will discuss on portfolio analysis.
Professor, I think you have to share your screen.
Your screen is not shared.
Yes, sir. Yes, sir. Oh, yep, yep.
Okay, carry on.
Is it visible, sir?
Okay, it's visible now. Yeah.
Yes, sir. Thank you, sir. So the topic for the discussion is portfolio analysis, and we'll discuss today construction of portfolios by taking 10 different stocks with the help of Excel sheet that we'll discuss in today's session. So let's start with what exactly is portfolio analysis. When we talk about first portfolio, we'll discuss what is exactly the portfolio. Portfolio means combinations of two or more assets. When we say portfolio, right, we are talking about not individual assets, we are talking about combination of either two assets or more than two assets when we combine together, and when we invest in different assets together, it will become a portfolio. And this portfolio, we need to analyze what is the returns for that combination of all the assets and what is the portfolio risk over there, right? So when we say portfolio, it's nothing but it's a combination of two or more than two assets, right? Now here we talk about portfolio returns, right? So when we say portfolio returns, right, what is exactly portfolio returns? When you invest into, or we can say more than two assets, your returns is function of what is portfolio returns. Now when you invest in two assets or more than two assets, whatever the returns you are getting from that portfolio, it is a function of various parameter. The first parameter is the return is a function of first one, the return you earn from each asset. That's the first parameter. And the second function is the amount you invested in each assets. So that is nothing but your portfolio returns. So what we are trying to tell, portfolio return is a combinations of two or more assets returns. It is a function of returns what you earn from each asset. Let's say you have asset 1, asset 2. What is the asset 1 return? What is the asset two's returns? That is one aspect of function. The second one is what is the amount you invested in each asset. That is also very important to calculate the weight of the portfolio. So because when we say portfolios returns, that is expected return on portfolio, it's nothing but your return of individual assets and the weight of individual asset. Then we combine together, we'll get something called as portfolio returns, right? So basically, when we say portfolio return, so I will write as expected return on portfolio, or we can say RP, portfolio return R underscore P, that is portfolio return, is nothing but, let's say for example, I have two assets. One is Facebook and one is Apple company shares, right? So what will be the portfolio return for this particular function? So weight of FB into return of Facebook, right? That's the first asset, because portfolio cannot be for one asset. You require minimum two assets or more than two assets. Anything is acceptable, then only we say that is a portfolio. So portfolio return is then the weight of FB into return of FB plus another asset. Let's say you have Apple shares. So we will say weight of Apple into return of Apple shares. So now we have two assets. So individual asset weight, individual asset returns, then another asset's weight and return combined together will become portfolio returns, right? So that's a basic criteria for calculation of portfolio returns. Am I clear with this?
Yes.
Now let's talk about very important. When we understand portfolio return calculation, we have to know something called as portfolio weights, right? That's a very important parameter where we have to decide how much is a weight. So how do we calculate this weight? That we need to understand first. So portfolio weight is nothing but right here. So let's talk about portfolio weight. What is portfolio weight? Okay, we know the portfolio weight should be always equal to 1, right? So it is nothing but portfolio weight is nothing but summation of k of I is equal to 1. So weight of individual or multiple asset should be always equal to 1. So means the portfolio weight should be 1. How much ever combination you have assets, the weight should not exceed more than 1, right? So the portfolio weight should be equal to always 1. So it's nothing but, if I want to say weight of one asset plus weight of two assets and multiple assets, if I take all together, it should be equal to 1. So weight of 1 plus weight of 2, all the assets whatever, if I have 10 assets in my portfolio, means 10 asset weight should be always equal to 1, right? Let's say for example, if I have two assets, now we had discussed one formula for two assets, one is Facebook and Apple. So for two assets, so we'll discuss now two asset portfolio, right? In that case, how the weight will be calculated. Okay, so we know the same logic here. Summation of I wi is equal to 1. So it means weight of 1 plus weight of 2 should be equal to how much? 1, right? So weight of Apple, weight of Facebook should be equal to 1. So we can also rewrite like this equation. If I want to know weight of 1, I can also calculate. I don't know what is the weight of second asset, but we know the weight of total portfolio should be 1. So we can say 1 minus weight of 2. This also can be calculated, the weight of first asset, right? So either way you can do. If you know one of the asset weight, the total, you can just minus from the second asset, then you will get the weight of first asset. That's called as two asset portfolios weight, right? Is it clear this concept?
Yes.
Okay. Now let's discuss the further. Now we discuss weight, right? So when we say portfolio weight, or when we say expected return on RP, portfolio return is nothing but weight of first asset into return of first asset plus weight of second asset into return of second asset, right? So now when we talk about returns, now let's discuss the concept of return on two assets. First we'll discuss two assets, then I will go for multiple assets. So return on two asset portfolio. So how it will be calculated? When we say returns, it's nothing but we have to think on individual assets returns, right? So RP means portfolio returns. Now till now we were discussing portfolio weight, right? So RP is equal to, let's check, profit I'm getting from the first asset. There are two assets we're discussing. Profit of first asset plus profit of second asset divided by, now this is profit of one, profit of two, both the asset combined together. Now we must have done investment in again individual assets. So it means we can say investment in first asset plus investment in second asset. Even this also can be the way of calculation of your total portfolio returns, right? So further we have to know what is the weight of individual assets over here. We can rewrite this formula. So we can say RP, that's called portfolio return. It's nothing but investment of first asset divided by investment of 1 plus investment of 2, right, into return of first asset, right? We are talking about portfolio returns here, plus another way, second asset, how do we calculate here? Can anybody tell me what can come here in the second bracket? We are discussing two asset portfolio, investment of first divided by investment of 1 plus investment of 2 into return of 1, right? Here what can become?
Investment of the second asset divided
Investment
by
of second asset divided by
total investment, that is
to-
investment first
of
plus
first asset plus investment of second asset, right, into
multiplied by
R2,
return of the second asset.
return of the second asset. So this is nothing but your portfolio returns, right? Now, when we divide investment of first asset with total investment, that is investment of 1 plus investment of 2, you will get weight, right? This can be called as weight. So weight into this is the concept. We got weight. How do we get weight? This is the way of getting the weight here, right? So second asset weight, how to get? This is the second asset weight. Investment of second asset divided by investment of 1 plus investment of 2 into return R2. R2 is return of second asset and R1 is return of first asset. So this is the what we were trying to decompose this formula, right? Now further we can also write the same formula. RP is equal to return of portfolio is nothing but weight of first asset. Now this formula, this investment of 1 divided by investment of 1 plus investment of 2, I can write like this: weight of 1 into return of 1, right, plus weight of 2 into return of 2. That is also called as what? Portfolio returns, right? There are multiple ways of writing the portfolio. Even you can write like this also. RP portfolio return is nothing but weight of 1 into return of 1 plus 1 minus weight of 1 into return of 2. Even this is also acceptable formula to calculate portfolio return. Is it clear?
Yes.
So it's a very simple portfolio return for two assets. Okay, you can, the multiple ways of writing the formulas, because we sometimes how the question will come, because based on that you can take this any of these formulas, but all of us will give the ultimately the same answer only. It will end up in this returns only calculation. Now for example, if you have three asset, so let's say for example you have Apple company share, you have Tesla, okay, and you have Google. If you have three companies asset, so once again, is it a portfolio? I invested in all the three shares. First of all, the question is it a portfolio or not? Is it a
It
portfolio?
is.
It is a portfolio, right? So what investment meaning of portfolio says combination of two or more than two asset can be a portfolio. So investment in Apple, investment in Tesla, investment in Google, right? So now how do we calculate return for this one? We'll up, we can say PR, portfolio return, is equal to, so first is Apple, Tesla. So how do we calculate now? Let's imagine I give number 1, 2, 3, right? So what will come? Weight of first asset into return of first asset, right? What will be the second one? Second is Tesla, right? So this is first asset over. So what will be the second case? Weight of second asset into return of second asset plus third one is Google. So we can say weight of third asset into return of third asset. Is it clear? So can we make this formula very simple?
Yes, we can.
So if you have 20 assets with you, we're talking about financial asset because assets are two types, real assets and financial assets. So when we're talking about financial assets, if you have 20 assets with you, the same logic you can apply and calculate the portfolio returns, right? So why we are trying to do this kind of concept? Why we are not investing only in single asset, right? Why we are trying to do investment in multiple asset? So what is the reason behind this one? So why investment you are doing in Apple, Tesla, Google? Why not 100% investment in Apple? So there comes the concept of
Risk.
risk. So it's nothing but what I'm trying to do. I'm diversifying my portfolio. I'm diversifying my investment in different asset just to avoid the risk, right? So it means every asset will give its own returns and it will have its own risk, right? So all investment in one single asset, it's not cannot be a good option. So ultimately what we are doing, we are trying to diversify the investment in different asset so that we can try to minimize the risks, right? So that's the concept of over here when we say weight as well as portfolio returns, right? Now, what is in general sense portfolio return? When we say portfolio return, what exactly portfolio return? We can write like this also. Portfolio return is nothing but it's a summation of k I to the 1. It's nothing but ri into wi, right? That's nothing but a simple concept of portfolio return. So we end up with this concept that's called as ri means return of asset, wi means weight of assets. So how much ever you have assets, you can just take return of individual asset and multiply with individual weight and combine together you will get portfolio return. Is it clear?
Yeah. Yes.
So shall we move to the now risk calculation, portfolio risk?
Yes.
Okay, sir, you can move.
Yeah. So what is portfolio? Now every asset will have return as well as risk, right? So now we'll discuss what is portfolio risk now. Okay. Now when we say portfolio risk, right? What is exactly portfolio risk? Okay. So risk first what we can do, there are two ways. One is your variance, we call as portfolio variance, and through variance you can calculate the standard deviation. So whenever we calculating portfolio risk, we can also calculate portfolio variance and then square root of variance will take it as standard deviation. Okay. So now let's see what's the formula for calculating portfolio risk. Okay. So when we say portfolio risk, right? it's nothing but sigma square p, that is called variance, is nothing but 1 divided by n minus 1, right? Summation of n 1 rp means portfolio return minus expected return on rp square. So this will become your portfolio variance, or we can say variance of portfolio, right? Now let's try to understand this further concept. We can split this formula into two parts also. We can decompose this formula. For simplicity, what we can do, for a while you just try to ignore this concept for now, okay? We can decompose this formula like this. Sigma square p, that's called portfolio variance, is nothing but Ri, let's two assets. I'm discussing two asset risk first. Ri minus expected return on first asset, right? Into Wi, right? Plus, now this is first asset over. What is the next one? We have another asset with us, that is asset number 2. Okay. So we'll write as R2 minus expected return on R2, bracket close, right? Now since it is a sigma square p, that's called portfolio variance. So this is your first asset, this is your second asset, right? Into W2, that's called weight of second asset, to the square. So can I write like this also, this formula?
Yes.
Okay. So now what we are trying to do from this formula, this is your first asset. Let's say this is your Facebook and this part is your what? Apple. Okay. So return, actual return minus expected return. So we say actual return and expected return. It's nothing but what? Deviation into weight of 1 plus second asset actual return minus expected return into weight of second asset to the whole square. It becomes variance of portfolio, right? So ultimately if I combine together this formula, it can be like this: rp, that's called portfolio return, minus expected return on what? Rp, to the bracket close, to the power of square. So it means this aspect of portfolio we got from this. So same formula we decompose into two assets. So it's nothing but your portfolio returns of both the asset minus expected return on portfolio to the square, right? So now we, how do we get this concept over here? So let's say Facebook and Apple, there are two assets, right? So we can say when we are writing this formula square p, let's assume this is a means Facebook, okay? Apple is b, okay? So this is a and this is your b part, right? So just try to remember, when we were doing the concept of, in the school level we have discussed the concept, right? Let's recall the concept of, we have a, we have b, means a plus b, right? There are two asset. So we are discussing two asset portfolio risk, right? So what happened now? What is a here? What is a here? We called as what? Facebook is your a, Apple is your b, okay? So what is a here? Ri minus expected Ri, and what is b? R2 minus expected R2 into weight of 2, right? So let's see, we can write like this: a plus what? B. Ultimately now you tell me, this is a, this is b, what is happening at the last? What is this?
Square.
Square. So it means this is completely a part, this is completely b part. So we can say a plus b what? Square. So We know this concept of a plus b square, right? So what we can write here, it's a basic concept what we will learn in the school level, right? So a plus b square, how do we write this formula? A square plus b square plus, now what we can write last one? 2 into
AB.
ab, correct, right? So how
Yes.
do we got this concept now? This is a square b square plus 2 into ab, right? So now we can decompose this formula. A plus b square means a plus b two times, right? So we can write like this also, right? A plus b into a plus b. That also makes same sense, correct? Now
Yes.
a plus b, that is once again your a plus b square is nothing but, now we will multiply these two. A into a we can write as what? A square plus a into b, that will become ab, plus b into a, the second one, first and second one we can write as ba, plus b into b will become b square, correct? So now can we write like this once again? A plus b square is nothing but, now can we take this one? A square plus, from common factor from here what we can take? B square plus 2 into AB or B into A. Will it be same only? So can I write it as 2AB? Is it making sense?
Yes.
So it means what? When we have two assets, we can apply the formula of A plus B square formula and calculate. The logic is behind the portfolio risk calculation is we can start with algebra, right? Later on we can go with further concept also. That's if we have two assets, then we can make these combinations of these two, right? So it's nothing but, when we, now we will put this into the formula. Shall I proceed this one? Shall I go to the next slide?
Yes.
Okay. So now, if I write this formula in portfolio concept, then how do we use this formula, right? So I'll write directly as sigma square p. It's nothing but, now it's a variance of portfolio. Now we have two assets, that is A and B. Let's say A is 1, B is 2, right? So we can say, when we are writing A square plus B square, right? A square plus B square plus 2 into AB. Okay, now let's see what will be the logic of this, right? So it's nothing but weight of 1 square Ri minus return of first asset into expected return of first asset, will do square. So what will become? This will become whole A square plus second asset, what we can write? Weight of second asset square into R2 return of second asset minus expected return on R2 square. It will become B square. So this part will become B square plus, what is the next one? 2, right? So we say 2 into, I'll write here, weight of first asset into weight of second asset, right? Now what is the last one? A into B, right? So what is A into B here? This is A, this is B, right? A into B. So it's nothing but R1 minus, again, expected return on R1 plus into R2 minus the second AB, right? Second part, expected return on R2, right? So we can write this formula into same concept. Now what happened here? This whole part was your A square, this was your B square plus 2 into AB. AB is nothing but weight of 1 into weight of 2 into return of 1 minus expected. So it means 2ab we have derived here. So now let's see this two last two, return of first asset into return of second asset minus expected return on second asset. So one asset, second asset. Now it's a variance. Okay, variance what? We can say when two assets are there, can we write this as covariance between 1 and 2, right?
Yes.
So it means what? We can further write like this same formula, sigma square p, okay, weight of one asset square into, now variance, right? It's a variance, ri minus expected return, deviation square, right? Deviation square, I can write it as standard deviation of 1 square plus next one, weight of 2 square plus standard deviation of 2, that's the second part, square plus 2 into, what is the first one, weight of 1 into, what is the second one, weight of 2. Now what is the this one, now it's this variance, right? So into covariance between 1 and 2, right? So whole formula I replace with this variance concept, right? Got it everyone? Shall I proceed this one further?
Yes.
Okay. So now if I remove the variance, then it will become what? Standard deviation. So we can write as standard deviation of P, that's called portfolio risk, right? Is nothing but square root of a plus b, a square plus b square in plus 2 into ab. So we can say root of the whole thing, I converted into root now, weight of 1 square into standard deviation of first asset square, right? That's called a square plus weight of 2 square, a plus b square. So b square nothing but standard deviation of 2 square second asset plus 2 into ab, right? So just multiply 2 into weight of 1 into weight of 2 into, now what is the next part over here? We can also take here, when we took variance over here, right, root of standard deviation of 1 into standard deviation of 2 into correlation between 1 and 2, right? So that becomes your standard deviation of P, that's called as portfolio risk of the asset. Is it clear?
Yes.
So this is how we calculate the portfolio risk of an asset, right? When there is a, how many assets we discuss? Only for two assets. Now the question here is, there may not be always two assets. There can be more than two asset also, right? So in that case, how to calculate this concept of portfolio risk? Then it becomes too much of tedious work to calculate the, when there are 3, 10, 20 assets, then how to calculate that particular aspects. Now that's where we get the concept of, we'll use the one formula over here called as variance covariance matrix. Okay. So let's say for example, what's the logic behind this two calculation? So this is your standard deviation of P, and we first one, what was the expected return on RP? Now this is your risk calculation. The whole formula is for portfolio risk. What was the return formula? Weight of 1 into return of 1 plus weight of 2 into return of 2. So this is return formula of portfolio return. So we discussed two assets, risk also and return also. So this formula is for portfolio return and this formula is for portfolio risk. Is it clear both the formulas? So that we can
Yes.
start with next assets. Okay. So what was the logic? A square plus B square formula we applied and we got this particular concept over here. Okay. Now let's imagine if you have three assets. Okay. Portfolio risk for, or we say portfolio returns for three assets. Then how to calculate in that case? We'll apply the same logic over here, but we can also use here one more formula called as, once again we can recall that formula for our school level, right? There we used to have called as a plus b plus c square, right? So this will be for how many assets? This will be for three assets. So we discussed till now for two assets. Now we will discuss, let's say for three assets, how do you calculate? The same logic we will apply here also. Apple, Facebook, and Tesla, if three stocks are there, then how to calculate portfolio risk? The same logic will come here. So what will become a plus b plus c square, right? So it will become a square plus what? B square plus c square, right? Plus now we have to make a combination now, because remember when we're doing portfolio risk we have to make a combinations of assets, right? So what are the combination we can make? 2 into AB we can make one combination, plus 2 into AC we can make one combination, plus 2 into BC we can make one combination, right? So it means if you have three assets, so how many times you have to do? Plus 2 into AB plus 2 into, means weight of AB, standard deviation of AB, then correlation between A and B, then again plus two assets, weight of A, weight of C into standard deviation of A into standard deviation of C, correlation between A and C, again it will add plus weight of B into weight of C, then standard deviation of B into standard deviation of C, then correlation between B and C. So it means imagine how many combinations we are making here, right? So this also can be written like this, right? So if I write this formula, A plus B square, so it's nothing but A square plus AB, that's the first concept, right? AB plus, we can make the combination of AC, then plus BA plus B square plus BC plus, we can make one combination of CA plus CB plus C square, right? So ultimately this will end up in A plus B plus C square is nothing but A square we can take here plus B square we can take it here plus C square we can take it here. Now let's make the combination of 2 into AB plus 2 into AC, that's one combination, plus 2 into BC. So that's how we can derive this formula for taking how many assets? Three assets, right? So it means we can use the same thing here. We can put that formula A plus B plus C square. We can use this formula to calculate the portfolio risk of three assets. Is it clear?
Yes.
So now next concept, okay, when we say let's check more than three assets, then how many times we can write? That's a, once again, very much heavy work to do for this, right? So we can use one concept we'll discuss. Let's imagine you have six assets with you, then how will you make the portfolio combinations? You have six assets with you, right? So again, imagine how many times of combination between A and B, B and C, like this. So it's a heavy work we need to do. The whole formula will become so large, right, for calculation. So here we can replace this concept with, we called as, we'll use the variance covariance matrix. So the algebra, from there we can come to the here matrix wave also is the way to calculate the portfolio risk asset, right, of assets. So let's imagine what this concept of variance covariance matrix. So we say basically VCV matrix, variance covariance matrix we can apply here if you have six assets with you, right? So what is the logic of doing calculation here? Okay, just let's say I'll put into a matrix. So we have know the concept of matrix, right, how it works. So what we'll do, let us make six combinations over here. Okay, the first combination goes like this. VCV matrix is nothing but standard deviation, okay, of 1 comma 1, right? This is the first asset. So now we have asset, right? Now what we can do here, this 1 comma 1, right, then we can write standard deviation of 1 comma 2 like this for one asset with different combinations I'm using. So I can write this also like this, 1 comma 1, can I write it like this, standard deviation of 1, 1 how many times 2, so it will become what, square, right? Got it, this one? So second, in the same line we can write standard deviation of, it is 1 comma 1, so this will become 1 comma 2, right? 1 with second asset, correct? Next, what can be the third one here? Standard deviation of 1 comma 3, 1 with 1, 1 with 2, 1 with 3, right? What can be the next combination we can make? Covariance matrix here, 1 comma 4, right? Next, standard deviation of 1 comma 5, then next one 1 comma 6. This become my first combination. Is it clear, the first line what we are trying to do it here?
Yes.
Okay, now what will be the second line combination here? Now this is first asset with second asset, first asset with third asset, first asset with fourth, first asset with fifth, first asset with sixth. What will be the here second combination we can make? Standard deviation of 2 comma 1, right? Next what will come? 2 comma 1, next one.
Two comma two.
Yeah, 2 comma 2. Once again. Just so 2 comma 2, right? So 2 comma 2 means 2 is 2 times, means can I write standard deviation of 2 square here?
We can write.
Yeah. So it means next what will come? 2 comma 3, then 2 comma 4, standard deviation of 2 second asset with fifth asset, third asset with 2 comma 6. Correct? Now shall we go to the, how many asset we have to form? 6 assets, right? What will be the third now? Third line. Standard deviation of 3
Three
comma
comma one.
3 comma 1. What will be the next one? Standard deviation of third asset with first asset. Variance covariance, right? 3 comma
Two.
2. Then standard deviation of 3 comma 3 means 3. Can I write it here square?
Yes,
Next
sir.
one 3 comma 4. Then 3 comma 5. 3 comma 6. What will be the fourth one? Fourth asset with first combination. 4 comma 1. Then standard deviation of 4 comma 2, then here 4 comma 3, then here what will come, 4 comma 4, But 4 comma 4 means, can I write square of this? What will be the next
Yes,
one?
sir.
4
4
comma
comma 5.
5 and then 4 comma 6. So we can same way 5 comma 1 we can make 5 comma 2, right? Then 5 comma 3 with 5 comma 4 with 5 comma 5 means it will become how much? Standard issue 5 square. Yes, 5 comma 6. And last one is will be your 6 comma 1, 6 comma 2. Then what will come next one? 6 comma 3, 6 comma 4, 6 comma 5, and this will become 6 comma 6 means 6 square. Yes or no? So imagine how many combinations we can make between the asset, what we are trying to say, right? Now if I ask you one question here, right? Standard deviation between 1 and 2 and 1, will it be same? This variance covariance between this
Yes.
asset and this asset will be same, right?
Yes.
And 3 and 1 and 3 will be same, correct? So like this, 4 and 1 and 1 and 4, 5 and 1 and 1 and 5, 6 and 1 and 1 and 6 will same, right? So it means what we are trying to do here, we got something called, in variance covariance matrix we get something called diagonal matrix. Okay, follows something called as diagonal approach. So what is this diagonal approach? Look at these combinations. Did you got this one? Between 3 and 2, variance between 3 and 2 and variance between 2 and 3 will be remain same. So I need not to take. So what I can do now, just take the diagonal matrix over here between the assets. Are you getting this concept now? Is it clear what we are trying to form here?
Yes, sir.
So now you tell me what and all we got from this matrix. Now we remember weight of one asset into standard deviation of one asset square, right? Then weight of 2 square, standard deviation of 2 square, then standard deviation of 3 square, 4 square. So that is what we used to do here in this formula also, right? So this was for 3 asset. This will be for how many asset? 6 assets. Is it clear what we are trying to form here? Shall we proceed or any doubts here?
No.
Hello,
We can proceed.
we can proceed, sir.
Yeah.
Others, ma'am? Okay. So it means now same logic shall we apply here? We'll go to the data set with our Excel.
Yes, sir.
New data have been shared.
Yeah,
Okay.
yesterday I think I shared portfolio data, right?
Okay. I'll download.
Can you everyone see my screen? This one.
Yes, sir.
Okay. So what logic we were applying, we'll apply the same logic here also, okay? So once everyone ready, please let me know so that we can calculate the risk of the portfolio and return of the portfolio from this data set.
Yes, it is
Okay.
ready.
Others are ready, sir?
Is ready now.
Yes, sir. So let's do together now this analysis. The first thing what we have to do, we'll calculate. Now first we'll understand what is this all about. There are how many stocks are there? Its total count is 10. So we are going to make the combinations of 10 assets, right? So there are 10 assets. Just now we discussed formula for 6 asset, but we can make portfolio for 10 asset also, right? So there are 10 different companies are there and their prices of shares are given here. What we are going to do, we are going to calculate the portfolio risk for this particular 10 assets. Portfolio risk and portfolio returns, both we are going to discuss here. Okay. So the very first thing what we are going to do, we are going to calculate the returns of individual asset, right? Because we discussed in the theory, returns of individual asset into weight of individual asset into plus second asset goes on, right? So let us give the names here. So we'll give name like this: R underscore, what is the first company name? Intel. Then R underscore Snap. Then R underscore XOM. R underscore NIO. Then R underscore ABBV. Please give the name. R means we are talking about returns here. Okay. R underscore NVDA. R underscore ROK KNSL. R underscore SAIA. R underscore Google. So everyone are ready? Yeah. The first day returns will be 0. So I'll write it as NA here. This will be the same for all the 10. Shall we calculate?
Yes, okay.
Yeah. So what we'll apply simple return formula, that's nothing but today's value divided by yesterday's value. So is equal to, first is Intel company, this value divided by yesterday's value minus 1. We got this one. So today's, this is Intel company's returns we got here. So what we can do now, we want remaining 10 companies, we can just click plus and drag it on the right side. Got it? Like this we want for all the days, right? So what we can do, just once you drag on the row side, just click on the last column, that's the black color autofill, double click on this, you will get written for all the days. You ready? I'll wait for 2 minutes. Please calculate these returns.
Yes, done.
So, I'll put it in the all border. Just okay. So we got daily returns of all the 10 stocks. Okay. So now we'll go to sheet 2. Please click on add sheet 2. Just once. Click on sheet 2. Okay. Here we'll write down number of stocks. How many stocks we have?
10 stocks.
Yeah. Total we have 10 stocks, right? Yeah. So please write down in sheet 2 10 stocks. Okay. Next one. We'll leave some space here. The formula I'll tell you that what exactly the formula will come here. We'll write E R expected return, then variance, standard deviation. So please write down this on the left side. ER expected return, variance, standard deviation. That is daily standard deviation. This is your daily, and this will become annual. Now, what we'll do, we have to write the company's name here because there are 10 companies, right? So what we are going to do, place in B3 column, we can press is equal to. Okay, go to sheet 1 and just select this name of the company. First one is Intel and click enter. Did you got it? Okay. I want remaining 10 companies name. There are 10 stocks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I think till K it will come. What we can do, just click on this plus and drag it till K. Last stock is Google. We got the names of the company here. Got it? Everyone got? And we'll select this one. We'll make it border. So shall we do the calculation?
Yes.
Yeah. So now first one what we'll do, we'll calculate expected return, but this expected return is nothing but average return of individual. So what will apply the formula is equal to, please write down average. So first is which stock? Intel. So we'll calculate Intel's average return. Go to sheet 1. Okay. So here we have Intel. So select from L3, that one. Click on that one. Control Shift Enter and close the bracket. Enter. Did you got the returns? Average return of Intel. Shall we?
Yes.
Right. So now this is for Intel. We also want for remaining companies, right? What we can do?
This is daily returns you mean, right?
Yeah, it's a daily return, sir. It's a daily average return.
Yes.
So drag it right side. You will get the remaining stocks also returns. Right. So now, once you finish, let us do later on that variance daily and standard deviation annual. Just later on, what we can do here. Okay, we'll use the formula here. We'll write the name of the company here also once again because we need weight, right? You just type this formula here, transpose. Okay, type in A10 somewhere and select this name of the company. Close the bracket, enter. Okay, and here we will type weights. Then we'll type here sum of weights here. Now we have to get weight for individual stock, right? Everyone ready till now?
Yes.
Okay. Now what we'll do, we know we'll there are 10 stocks are there. What I will do, assign the weight for equal portfolio, equal weightage for all the stock. So first we'll do that one. So how do we assign the equal weightage for 10 stock is equal to 1 divided by, so there are 10 stocks are there. I'll put it function F4. So each stock will have 0.1 weightage, right? So this will be for all the stock, it will be 0.1. Then we know the sum of weight should be always equal to how much? Sum of weight should be equal to how much? 1. So we'll assign equal weight for all the 10 stocks here. Is it ready?
Yes.
Now we'll use this concept now. This is called variance covariance matrix. Okay. Now what is variance covariance matrix? Now we have 10 asset. Remember this was formula we done for 6 asset. So we required in row 10 and column 10, 10 assets, right? We are going to make the combination between those assets. So what I will do now, I'll just go to here. Okay. We'll write the name of the companies here. Okay. So you copy this name of the company from here, just paste it opposite to that this one. So so we can here also we can use the formula transpose these 10 companies. Okay, and here also I can write these companies 10 Intel to Google, row and column both side. Then we'll select this one, entire this portfolio. Remember we're making portfolio of all the 10 stocks here. Okay, please select this one. Ready? Shall we start now?
Yeah, we can.
Okay, so now what we are going to do, we're going to calculate variance covariance between the stocks, right? So what we'll do, please see here, we'll select this one because we want entire calculation over here. So we'll select that one, okay, and we'll write the formula here. Okay, so first we'll start with, just see how to start the formula. I'll write here. We'll use one option called M mult. Okay, open the bracket, transpose. Okay, open the bracket. Now in the sheet 1 we will select all the returns of the 10 stocks. Select here, right side, control shift down. Okay, then minus sheet 2 all the weights of the assigned, that is nothing but your expected returns, bracket close, comma. Now this has become transpose now. Okay, so what we were doing, the returns minus expected returns, that we have done. Then again what we'll do, we'll go to same sheet 1, then select all the returns. Okay, minus in sheet 2 expected return, done. Then bracket close, divide this one with variance covariance, means 1 divided by n minus 1. So we'll write count. Okay, count of, again we'll go to sheet 1, we'll select all these rows. Okay, minus 1, bracket close, 2 times. Thing here, 1 second. Sheet 1 entire we have to select here. Okay, minus 1. What's not coming here?
Sir, you have to close the bracket after 1009.
Yeah, I think I will not close the bracket
You have
here.
to close the bracket after 1009. Am I right? Yeah, there you have to close the bracket.
I think
Then
I
only
will
minus 1 will come. Am I right?
just let me check with
It
this.
will be working.
No, 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 no.
Okay, this is my. Carry on.
No, no, it will come. So here I think I will not select one
One
of
more bracket.
one more bracket I will
And
no, no, no.
no, it is two more brackets we have done, sir.
Shoot a multi.
So not taking. Then I didn't get it.
Yeah, yeah, I'll do it once again. Yeah, I'll do it once again. This
Yeah.
one.
M alt transpose.
Yeah, yeah, we'll do it once again. I think here we missed. We have to select first this entire. Okay, we have to select this one, and because we want entire covariance matrix here. Mult. Then we can apply here transpose. Okay. Then sheet. We go to sheet one. Select all the returns. Minus sheet two. Expected return. We have to do it. Okay. Then we close the bracket. Then
Minus C2 expected return, right?
yeah, expected return. Then close the bracket here. Then press comma. Then again go to sheet 1. Okay. Again sheet 1. Now it has transpose. Then you have to multiply with that. Again we'll select the entire returns here. Minus sheet 2 value close divided by count
What
of
did you do? Sheet 2
sheet 2 same expected return minus sir.
minus. Okay.
Count right. So we'll go to again sheet 1 count of done total count. Then we'll put here minus 1. Okay. Control shift enter you press. Oh, no. It's not getting here. Something wrong.
I got it.
You got it, sir? Some missing bracket. Sheet 2 of so I think it's correct only, but don't know why it has come this one. Count of I'll check it once again. Minus Not coming.
I too got it, sir.
You got it?
Yes, sir, I got it.
You got variance covariance between the diagonal matrix?
Yes,
Those
sir,
two,
using this formula only.
those two got just compare your formula with our SARS formula. There will be something in bracket. If you check it, that will also get the correct answer.
Those who get the correct answer, you check your formula with what is available in the screen so that we can easily get it.
Yeah.
Thank you.
I'll just check it with my this one.
Yes, sir.
So can we calculate now here variance of this formula? We can calculate variance here. So let's comes to here variance dot s. Come to this part. Okay, type the formula here variance dot s. Okay, open the bracket. Now for Intel company, let's see what is the variance. Go to sheet 1. Control shift down and close the bracket. Select the returns all. Did you got this answer?
Yes, sir.
Yes.
Okay, now what we'll do, we want the variance of all the other assets, right? So what we can do here, we can just drag it on the right side. We'll get the same variance for all the other assets. Got it?
Yes, sir.
Now what is the next one? Standard deviation. So variance we have, standard deviation we should calculate. So how to calculate is equal to SQRT square root of what? Variance. You will get this value. Got it everyone? Just drag it on the right side. Then completed.
Yes, sir.
So now daily standard deviation we got. We can convert this into annual standard deviation. So what we'll apply here formula is equal to daily standard deviation into square root of how many days we'll take it. Last I think we consider 250 days, right?
Yes.
So we'll get this annual standard deviation. Just drag it on the right side. Got it? Now convert this into percentage. This is your individual stock standard deviation, and this standard deviation daily also please convert into percentage. This also you can convert into percentage. Done. Completed.
Yes, sir.
Okay. So now let's go down this one. So you come to this variance covariance matrix. Just we'll see the result here. Now look at here. Intel companies and your variance covariance between that is 0.005987, and here you can see the other companies also here. But snap between variance and covariance between snap and snap is same only. So it means, we remember we used to see here in this concept diagonal matrix 1 square, then 1 comma 2, 1 comma 3, then 2 1 2 1. So it means standard deviation between or variance covariance between 2 and 1 and 1 and 2 will be same, right? So which approach we should follow here? This is nothing but your diagonal approach, right? So it means ultimately what is our answer here? So can we take the diagonal approach of this one? So let's highlight this one, come to this one. This is one, correct? It should be same with variance of Intel, right? Is it same value both? Next one. Here also we have the same value for this one, Snap company. Here also it is the same value, third one. Here also we have the same value. So just highlight with red color. Is it the same values of what variance we got here, and this highlighted variance are both are same?
Yes.
So variance covariance matrix is, that's how we can form here. So based on this one we can form, calculate our portfolio risk here. So shall we go ahead now? Next one. Did you highlighted this one? Look at this value between snap and snap, 0.003990, and this is same only. So 1 and 2 and 2 and 1, that is same. So like this we have 10 portfolios or 10 assets with us, which has combined together and form the portfolios, right? So now what we'll do now, we'll calculate the variance of these portfolios. So let's come down here, write on variance of R underscore P, variance of portfolio. Done. Next, once we calculate variance, we can also calculate standard deviation of R underscore P. That's called standard deviation of portfolio, daily standard deviation. Then we can convert into annual standard deviation of portfolio, R underscore P. Done. Shall we start now to calculate variance of portfolio? Sorry. Done. Till here it is clear. Shall we calculate?
Yes.
So let's calculate the variance of portfolio here. So we'll take again same formula. Transpose. So we'll select the weight, bracket close, comma. Now it has got transferred, multiplied with variance covariance, right? Comma. Select the weight, close the bracket. Did you got this answer? Shall I show the formula? What we are trying to do, we are first transposing the weight, okay, and then we are multiplying with variance covariance with weight. Is it clear?
Yeah.
Now this is exponential value here, but if we can convert this into decimals also, we can format the cell and we can just change, increase the decimal here. So that's your daily variance. Now can we calculate daily standard deviation? Is equal to square root of what? Daily variance. You will get standard deviation, that is daily standard deviation. I'll convert this into percentage. First we'll calculate annual standard deviation also. So how to calculate annual standard deviation? Daily standard deviation into square root of 250 days. So now both I'll convert this into percentage. Did we got this answer? Portfolio risk.
Nine 9.7.
9.71, two decimal somewhere this. So how did we got this one? First we calculated variance, that's daily variance, then daily standard deviation, then annual standard deviation. So daily variance of portfolio is nothing but first we converted weight into transpose and then we multiplied variance covariance with weight and then we got this variance, daily variance. If, uh, others got the answers, the same answer what we got. Shall we go on to the next one?
Yes.
So then what is portfolio return? So shall we calculate portfolio return now? So what we should apply, expected return of portfolio, right? RP, expected return on portfolio is nothing but total how many assets we have? 10 assets, right? So weight of first into return of first asset plus weight of second asset into return of second asset, right? And it will go on till the last asset, right? Weight of K into return of K. So now what and all we need? First we'll calculate here. We'll take the name of the company. So let's take transpose function here. First we'll write down the name of the companies. Okay, so we got name. So here we have returns of individual assets, right? E of R expected return, and here we have what? Weight. Correct? Then we will take E RP, that is expected return on portfolio. So click here and make it this box. So what is the expected return? Again I'll take it individual asset daily returns over here. So is equal to, here also I'll apply transpose. So this daily returns what we got here, just take it that values, close the bracket and enter, and we can take the weights over here, that is equal weight 0.1 for all the assets, right? So expected return, we can say this is my daily expected return. So shall we, this is what we are going to apply the formula here also, weight into return plus weight into return of second asset, like this for 10 asset we'll calculate. Shall we calculate?
Yes.
Okay, so now what we'll do, we'll apply here one formula called sum product. Sum product. So please type this one. Sum product, here we'll take expected return of all the assets, comma, weight of all the assets, that is equal weight, close the bracket, enter, that's your daily return. So annual return, annual expected return, annual returns, let's calculate here. So daily return into 250 days, that's your annual returns. So convert this into percentage, go to home, this also convert this into percentage. Got it, this answer? Done.
Yeah. Yes.
So we have ERP, that is expected return on portfolio, and ERP expected return on portfolio, and one is risk of portfolio. So if you take the annual return of this portfolio is 32.17, and the risk of the portfolio is 9.17. Done. annual returns and annual risk of this portfolio. Everyone able to follow this one? What we're trying to build the portfolio model here?
Yes.
So here we got to know how to construct the portfolio for 10 assets we constructed. So that is by considering each asset equal weight portfolio. This is, you can assign any of the weight, and according to that you can change the weight and you can get the answer. So this is available with us only. So that's what we were trying to do from this. So what was my portfolio returns calculation? So we were discussing this concept here. So return of portfolio, it's nothing but weight into return. That's what we calculated from this. So portfolio return is nothing but summation of ki is equal to 1 return of each asset into weight of each asset, and portfolio risk we calculated by taking multiple of 10 assets we had. So we use this variance covariance matrix formula and we got the portfolio risk here. So, right, shall we go to the next concept? So is it able to follow it now? Shall I go to the one more concept we left with over here? Shall I go to the next concept? So if you have finished this one means, hello, Dilip sir,
Yes.
am I audible?
Yeah, yeah. Yeah, yeah, you're audible.
Shall we go to the next concept? So we done
Yes.
with your portfolio risk and portfolio returns calculation.
Perfectly, perfectly right.
Okay.
Yes.
Other, Natika ma'am, Divya ma'am. So next concept I'll discuss here. There was one concept which we need to discuss called as shorting. Is it screen is visible?
Yes, it is.
Right. So let's discuss this concept of what is basically shorting concept. Okay. When we say what is exactly this shorting concept, so we'll write first one as shorting is a way of making money when the price of an asset decreases. Okay, it's a way of making money when the price of any asset decreases. So here two concepts we should understand in shorting. There is something called as go long, right? So we say long and short concept here, right? So what is go long concept here? When we say go long means we are going to buy a stock, and second one is go short. That means we have to sell the stock. So short means selling a stock, long means buying a stock, right? Now, in other way, what we can say in shorting, basically what we're going to do, okay? You're selling an asset, you're selling an asset, you do not own, and buying it back when the price decreases, when the price of that asset get decreases. Now let's understand how this process of shorting happens. Okay, first we'll discuss one example here. I'll take an example of Amazon stock price. Okay, now let's imagine this is today's price of Amazon. Today's stock is somewhere trading at $1,300. Amazon share price today, it is trading at $1,300. 3 months later, after 3 months, this stock, it can go up, the price of the stock can go up, or the price of the stock can go down. Okay, suppose for example, after 3 months the stock price goes to somewhere $1,500. Okay, it can go up or it can go down after 3 months. After 3 months it will fall, let's say somewhere at $1,000. Okay, now today's price of Amazon is 1,300. After 3 months, it may go to 1,500 or it may go to $1,000, right? So now can we first let's see between 1,500 to 1,300. We'll write the difference here. What is the difference amount here? 1,500 to 1,300. What is the difference of price? 1,500 to 1,300. What is the difference? Is it 200? Right?
Yes.
And here, what is the difference? 1,000 to 1,300 difference, we can say how much? Somewhere $300, right? Now from this chart, the what we can see expected, okay, because it's just an expectation that it may go up or it may go down. The expected decrease means from $1,300 to 1,000. Expected decrease difference is 300, which is more than expected increase. Correct? Is it clear this what we discussed till now?
Yes.
Yeah. So let us continue. Now there are two concepts I told you, right? Go long and go short. Okay. Let's imagine we'll discuss in this only Amazon short, go short. We'll discuss first go short. Okay. And what you expected that has happened. Okay. Short gone right. Okay. So what we'll do now in shorting process, what happens? Let's see. First, what we'll do, we'll borrow. Let's say I'm borrowing 100 shares of Amazon. Okay. At a price of, today what was the price? $1,300, right? This is your T naught. Today I will borrow 100 shares of Amazon at $1,300. Okay. So can I know what is my total investment in Amazon now? Each share is $1,000, $300. I borrowed 100 shares. I took 100 shares. So what is the total value? 1,300 into 100 shares I borrowed. My total investment is how much?
1 lakh 30.
1,30,000, right? So I purchased 100 shares of Amazon at a price of $1,300. So my total investment is 1,30,000, right? Let's check. This I borrowed 1,30,000 at a borrowing rate. Okay, borrowing rate in the market is 3% per annum, right? Now, what we discuss after 3 months, the stock of this will go to some price, right? So after 3 months means 3% is per annum, right? So it means three months will take it per annum into quarterly. So 3% per annum means divided by 4. So every quarter how much interest I have to pay? 3 divided by 4 is somewhere 0.5% per quarter, right? Is it clear? Why we converted per quarter? Because after 3 months, right, we are expecting that prices may go up or go down, right? So now can we calculate the interest on this? Interest of how much percent? 0.75%. So on 1,30,000, if I calculate 0.75 percentage, what will be the rate of interest, amount of interest? 1,30,000 into 0.75, how much?
97.5.
0.7, 97.5. Is it
It's a
9
percentage, right?
percentage, sir?
97.5.
1,30,000 into 0.75 is 97.5 or 975? Is it correct? Shall we proceed now? Next one. Is it correct?
Yeah.
975? Okay. Now what I will do?
Yes.
What I have borrowed this 100 shares, I'll sell this 100 shares at, okay, what price? I borrowed 100 shares at $1,300. Okay, and I will sell these same shares at a price of $1,300. So it means I will get total investment. How much money I will get here? 1,30,000, right? So now what we'll do, this 1,30,000 I will invest. Let's say if I invest in some government treasury, okay, and there let's assume the saving rate or the rate of interest on government treasury is 2% per annum. So again I will convert this 2% per annum into quarterly. So every quarter I will get interest of how much? 0.5%. So on 1,30,000 I will earn interest of 1,30,000 into 0.5 is dollar 650 rupees, right?
Correct.
So what I did, I borrowed 100 shares and immediately I sold these 100 shares at $1,300, and then I invested this 1,30,000 in government treasury where the rate of interest is 2% per annum. So every quarter I will get $650 as my interest. Okay. Now what will happen after 3 months? Now let's discuss after 3 months. Amazon share price. Amazon share price will fall to, let's say, $1,000. Okay. After 3 months, just now we were yeah. After 3 months, let's check the price fall to how much? 1,000. From 1,300, it has fall to how much? $1,000. Now what I will do now? After 3 months, again what I will do? I will buy back this 100 shares. I'll buy back this 100 shares for what price I can buy back this 100 shares? After 3 months. So how many shares we have? We are buying how many shares? 100 shares. After 3 months, what will be the price of the shares? It will go to how much? 1,000. So I will buy back at what price? 100 shares into $1,000 total. How much?
1 lakh.
It means we will buy back at 1 lakh rupees, right? Now, further continuation of this one. Okay. This after this, when I buy back that 100 share for 1 lakh rupees, now I will return that one. Returns the share. Okay. How many shares? 100 shares at $1,000 each. Now I have borrowed this 100 shares, right? Let's say I have borrowed it from my broker and I am paying him interest of 0.75. Now I am returning that 100 shares to him at $1,000 each. Now in that case, I have to return the shares along with interest, right?
Yes.
So now let's calculate what is my profit, what is my loss here. Okay. So how much we have invested total amount initially? We have invested 1,30,000, right? Now I'm same thing. I'm returning these shares at a price of how much? Total investment I'm giving at 1 lakh rupees.
1 lakh.
So what is the difference now here? Dollar 30,000. Now what I'm doing now, I have to pay him some interest, right? So what was the interest? We are going to first we will calculate our interest. So add interest here. We will get some interest, right? Where we quarterly interest we got somewhere around how much? 650. So
It's fifty.
my dollar interest. So my total return is dollar 30,650 rupees. Okay. Now tell me, from this I have to pay interest to my broker, that is quarterly. That interest amount is how much? 975 rupees. So I earned 650 interest, but I have to pay him with interest the return that shares with interest of 975 rupees. So I will minus his interest of $975. So now still I left with how much amount?
29,675.
29,675. Now what is this 29,675 for? Is it a profit or loss for him?
Profit.
It's a profit for him, right? Now this profit, how did he earn? Because when the dollar price of that Amazon share price went to how much? $1,000, right? Now what will be the case? What if the price goes up to 1,500? This also can happen, right? So in that case, what do you think? He will earn profit or loss when there is $1,500?
If he's a short position, loss.
Then there is a loss, right? So it means if his expectation went wrong and suddenly the price has increased from $1,300 to $1,500, then he will earn the loss. If his short position went correct, then he will earn the profit, which is equal to how much? 29,675. But there, if it is a loss, there also we can calculate the same thing, but instead of taking everywhere 1,300 and $1,000, we can take it here 1,500. So we'll get the loss. That's it. That's nothing but shorting position in both the case, when the expected price to be increase or the expected price to be decrease, in both the case. That's nothing but your shorting process over here. Is it clear?
Yes.
Yeah. Any doubts here till now? So we have discussed here the shorting process which was pending from my side. And just so any query here?